Today's read confirms inflation is still on a downward trend and that the Fed can take the rest of the year off. Let's bring in Ed Yardeni of Yardeni Research. Ed, I don't know that they're going to necessarily immediately say that they're taking the rest of the year off, but it's certainly in wait and see mode. And I guess you're not afraid, as many are, that we're going to get to a sticky place in terms of inflation and the Fed's going to have to tighten things a little more?
I think we're past the sticky side of things, because if you look at the CPI headline inflation rate, excluding shelter, which includes that annoying component called rent, we get a 2% increase on a year-over-year basis. If you look at the CPI core rate, excluding food and energy, and then take out shelter, you get 2.5%. So we're actually below 3% on these kind of measures. And so it's really all up to shelter. And shelter has been sticky, but I think it's starting to come down. And it's coming down because it's starting to reflect the fact that inflation on new leases has come down sharply. It's actually down on a year-over-year basis, according to apartmentlist.com.
It's true. You'll have others talk about 4.4% annualized wage growth and the fact that we have a lot of these union contracts getting pushed through and diesel costs can get passed along into core services. However, all that being the case, has the market already kind of gotten to that spot where it's assuming that the Fed's just about done and we have the soft landing in place, or is there more upside to be gathered from that being confirmed?
Mike, I've been forecasting 4,600 on the S&P 500 by year end. We got there on July 31st, so we got there about 5 months early. So now what do? I don't really feel like it's appropriate to raise my target here because valuations are stretched, and I do want to see that earnings kind of catch up with the market. So I think we're going to be kind of trading around this level, just below 4,600, around 4,600 through year end. And then I think we have another good year next year. But for now, I think that the market has discounted the likelihood that the Fed has finished raising interest rates for now, and that inflation is going to continue to moderate, and that the economy is going to continue to hang in there pretty well.
It is remarkable, given that, 1 month into the third quarter, you have the real-time Atlanta Fed estimate for GDP growth pushing 4%. Nobody really accepts that on its face. However, even with that, you have plenty of folks saying deceleration is observable elsewhere. And, we got under 200,000 jobs last month. It's probably headed down from there. In other words, the recession call has mostly been deferred and not taken off the table. Does that make sense at this stage?
Well, I think you've got fewer economists predicting a recession, but you're right. I mean, we're not out of the woods yet. The fact is the Fed has raised the short-term rates by over 500 basis points. The fact is mortgage rates are back up over 7%. So there's still some kind of restrictive policies out there. And we saw that in the Moody's downgrade of the banks. We saw that in March in the banking crisis. And we've seen it in the SLOOS, the Senior Loan Officers Opinion Survey that the Fed puts out. So credit conditions are going to keep the economy from booming here. But I don't think we're going to go into recession. I think we've been in a rolling recession, hitting different industries at different times. I think now we're actually probably seeing something of a rolling recovery, particularly in the goods sector. I think the worst of the recession in goods is behind us. And from here on, consumers are probably going to be a little bit more even in their spending. They've gone on a buying binge in services after their buying binge in goods. Now I think services slows, goods picks up, and then the consumer continues to spend. I mean, consumer spending, according to the Atlanta Fed survey you mentioned, is tracking at 3.5%. And I think a lot of that is, as Steve Litzman has said, a lot of it's because the June number ended up on a strong note, and you're kind of comparing averages over averages. So these are legitimate numbers.